equity markets opened higher this morning, sort of a hopeful start to a trading week. We'll see how it all goes here. Investors certainly keeping their eye on big tech this week. The Magnificent Seven, or many of them, are set to report earnings this week. And although the S&P 500 is down 6% from its all-time high set just 3 weeks ago, our next guest says it's important for investors to remember that the market has been in a state of drawdown of 5% for more than half of the time. So we'll put all of this in perspective. How is the current market correction impacting our guest's market outlook? Happy to say that joining us all here today to share his latest market thesis, including the macro themes moving markets, is Fidelity Director of Global Macro, Jurrien Timmer. Welcome. How are you? Great to see you.
Good morning, Pamela.
Happy Monday to you. Very glad you could join us, and we'll invite everyone to send their questions into you. Let's dive in, shall we? I mean, soft landings, you have said, also have corrections. So it doesn't necessarily disrupt the whole thesis. Is this correct?
That is correct. So let's sort of set the stage first and maybe go to slide one. Drawdowns happen all the time. And the market goes up 60-70% of the time, which means it goes down 30 to 40% of the time. So being down 5 to 10%, doesn't always feel good, but it's worth remembering that the current drawdown of 6% is happening after the S&P 500 went up in a straight line from last October until March 28th, and it went up 28% in that straight line. So, we need to kind of take that into some perspective. But if we go to the next slide, you can see that the market's been in a state of drawdown of at least 5%, 65% of the time. So more often than not, the market is below its high by at least 5%. So, we need to just kind of, relax a little bit. But of course, it's good to understand why this is happening. And I think, Exhibit A in that question is slide 3, which is interest rates. And so we are back, and we've talked about this for a while now, but we're back in this mode where rising yields, they make the stock market wobble, or they can make the stock market wobble. And that is different from the last, 2.5 decades, when rising yields actually were a sign that things were going well. Now, because the stocks to bond correlation was negative, but now the stocks to bond correlation is positive, which means that we don't want interest rates to rise, because if they do, that means generally either inflation's rising or real rates are rising. And so what we can see here is the 10-year real yield from the TIPS market in the orange bars there, and the VIX, which is a volatility measure for the stock market in the upper panel. And you can see that all the sharp increases in the VIX, which are generally declines in the markets, can be kind of attributed to increases in yields, and primarily real yields. So obviously we've had geopolitical headlines, and that obviously has a lot to do with this as well. But to me, the bigger cause of this reset, this wobble in the stock market, actually is the bond market.
It actually is the bond market, and we are, as you just mentioned, the difference in sort of the world we are in today in terms of fundamentals of, say, the last couple of decades. We're back to roughly what stocks and bonds and correlations meant a couple decades ago. Does that have any implications of where we should find sort of neutral policy? Like, should we understand neutral policy that we're aiming for now to be kind of close to what it was 20 years ago-ish?
That is, I think, the big question. Let's start with slide 21, just as a lead into that, just to kind of bring home the point from earlier, which is that rising bond yields, will have an impact on the stock market in a different way than it has, over the last couple of decades. So there's a lot going on in this chart, but the red shading in the back there is when stocks and bonds are positively correlated. The blue shading is when they're negatively correlated. And this is the so-called Fed model, which compares the valuation, the PE basically on the bond versus the PE on stocks. And when bonds move up in yield, they eventually reach a point where they pressure valuations on the stock market. And you can see during the red zone, that the bond PE and the stock PE, so the bond PE is just the inverse of the yield, were moving in lockstep the whole time. And then in the blue shading, they've moved completely independently from each other. And so that's positive versus negative correlation. And we're now back in the red zone. And that's a different regime than what we're all used to, many of us, on the show, or growing up in this market. So we're in a different, in my view, in a different regime. But to your question, and it's a very important one, what is a neutral policy? I think is a question to ask. And let's go to slide 16. Because here we have the Fed raising rates 525 basis points since 2022. We're at 5 3/8. You would think that that is a severely restrictive policy, but yet the economy is resilient and inflation has come down, but it's now proving to be sticky. It's not reaccelerating, at least not yet, but it's not coming down anymore. And so that does raise the question is the Fed really as restrictive as we think it is? So to set the stage, this chart, I've shown it in the past. The orange line is what we call the SOFR curve, the secured overnight financing rate or funding rate, which used to be the LIBOR curve or the Fed funds curve. It's what the market thinks the Fed is going to do. And at the beginning of the year, and we talked about this repeatedly at that time, that orange line went down to about 3%. Now it's down only to 4%. So the market has unpriced about 4 rate cuts correctly, because what was happening at the beginning of the year to me was just not very sane. So this is a lot closer to what it should be. But if we go to the next slide, the question is, what is a neutral policy? The Fed has always thought, actually, let's go back to the other slide for a second. The Fed has always thought, if you look at the purple dots, it says long-term dots, LT dots. That is from the Fed's summary of economic projections, where the Fed thinks that is a long-term neutral rate. And generally, the Fed has thought and continues to think that a neutral rate is 2.5, maybe 2.5 to 3. And therefore, at 5 3/8, the Fed is significantly restrictive, right? It's restrictive by 2 to 3 percentage points. But if we go to the next slide now, I would argue that it's probably a lot less than that, because inflation, so you see the purple line, the orange line, the blue line are 3 different variations of measuring inflation. It's about 3 to 4%-ish. And some of these measures are starting to get sticky at this 3 to 4%. And so if a neutral policy rate in real terms during periods of economic growth, so not recessions, but soft landings, no landings.
Mid-cycles, perhaps.
Mid-cycle, right? So normally the real rate has been about +1, +1.5. Now, if you add +1 to 1.5 to 3 to 4, you get to 4, 4.5, 5%. So in that sense, the Fed is not really that restrictive. And that could explain how the economy continues to be resilient, maybe why inflation is not being tamed as much as the Fed thought it was maybe 6 months ago. And it also implies, of course, that the Fed has less room to cut rates here because it's not that far above neutral. So I think that is kind of an important thing to be thinking about as we think about where does the Fed end? Is it even done raising rates? Could be another question. It's not my thesis, but it could be. And where do bond yields have to go? Bond yields are back at 4.62. And that's without any help from the term premium. That's all been real rates so far. And so these are all questions as we kind of put that into the machinery of what is the market worth and where is it going?
If we're going out on a limb here, but if, because it has been an interesting round trip from the beginning of the year, as you just pointed out. I mean, it's a pretty different way of looking at the markets at the moment and how they're being priced. But if you, again, go back sort of 20 years or to a different regime, Alan Greenspan, he was a particular person with a particular personality, and he made lots of sort of funny comments about which way the wind blows, but it was anything but forward guidance. I mean, it was the opposite.
He
And
used to say that if you think you understood what I just said, then I didn't say it very well, or something like that.
it was literally the mirror opposite. But in that sense, if we get a bit settled into we're here for longer, or however the markets sort of find comfort with that, or maybe they don't find comfort with that, do you go back to less forward guidance, I guess is the question.
Yeah, so it's interesting because I once um, uh, had the privilege of interviewing Ben Bernanke, and I asked him that exact question. It's like, the Fed's transparency today is the opposite of the old Greenspan days. And reading history books and speaking to him, it's clear that transparency became a feature when during the zero interest rate policy era, right? So in other words, the Fed would drop rates, they would get to the zero lower bound, they'd have no more room to cut rates, so they had to use other tools. And one of them, of course, is quantitative easing, so using the balance sheet as a substitute, if you will, for rate cuts. And the thinking was and still is that every so many hundred billions of balance sheet expansion is the equivalent of, let's say, half a point of rate cuts or something like that. And so that was one method to deploy when rates couldn't drop anymore, right? So if you used some sort of Taylor rule model or some sort of model that says this is where rates should be based on inflation and growth, basically those models would say that rates should have been at -3, but the Fed is stuck at 0, and therefore it had to deploy these other things. And the forward guidance and the dot plot, which was created in 2012, was also a means of telling the market, okay, we're at 0, and this is our way of telling you that we're not going to get off of 0, or that we will signal when we get off of 0, because they were afraid of deflationary expectations getting unanchored, if you will. So it was the complete opposite of the inflation paradigm. But so under the Greenspan reign, I mean, the zero bound was not, we were not in that space at all. And so I think, to your point, during the old, if we're back in the old regime of, maybe stickier inflation and kind of positive stocks to bond correlation, you could argue that the Fed should not be as transparent, because it really only became transparent to deal with these deflationary pressures, and those are, in the rearview mirror, at least right now.
So let's take the rate story, if you don't mind, to the earnings story, which I know you've got lots of comments on. We're entering earnings. Well, we've been in earnings for a little while, but we've got the Mag 7, I think 4 of the 7 reporting this week. And the general thought was Q1 of this year for Mag 7, but maybe for other stocks as well and other companies, Q1 might be okay, but we're looking to sort of Q2, Q3, because that's when rates will be lower. Or at least the guidance from each of these companies on the earnings calls and on the earnings story. How has that changed? Where's the estimates, the expectations on earnings?
That's a good question. So let's go to slide 13. And I'm looking at my Bloomberg here. So far, it's still early in the earnings season. 72 companies out of the 500 have reported. 80% are beating by an average of 9.3%, but 72 is not a critical mass yet. But if you look at the rate of growth in the forward earnings estimate, so this is for the U.S. emerging markets and non-U.S. developed, you can see in the gray line that U.S. earnings estimates are now growing at 12%. So that's a big improvement over last year. I mean, earnings never really fell that much last year. They fell about 2 or 3%, but they're accelerating. And of course, your question about the Mag 7 or Mag 5 or whatever it is,
Whatever they are.
they don't, even though they're long duration stocks, and you would think that the cost of capital in a discounted cash flow model would matter, and it should, but these are also companies that, they don't need to borrow money, right? They have tons and tons of cash. So they're relatively immune to what the Fed is doing, as opposed to a small bank, for instance, which is completely dependent on what the Fed is doing. So, so I think those stocks are are relatively immune from whether the Fed is going to be at 4 or 5 or 3. And even if the Fed actually were to raise rates, maybe investors would actually flock back to those stocks because they would not feel the pressure from rates. So I think that's the good news. But the important thing to mention, I think, here is, let's go to slide 15. And by the way, I just saw a question about where can someone find the charts?
Yeah.
We post all of this on X and LinkedIn. And actually on Monday, which would be today, we are now posting my full report that I write on Sunday called the War Report, the weekly asset allocation report. Since just a few weeks ago, we're now posting that report in its entirety on LinkedIn with a link to X. So you can see all these charts in their glorious detail. But let's go back to slide 15 for a second. So you can see here, this is real rates using either PCE or CPI or the TIPS market. And you can see the dramatic repricing in real yields over the past couple of years. That's obviously what this whole episode has been about, why stocks and bonds are now positively correlated, et cetera. It's hard to see. You have to like really squint here. But the reason I'm mentioning is because last October, the market, so the market bottomed in October of 2022. And it rose and rose. And then last summer, it started to wobble because interest rates were starting to back up. The bond yield, if you remember, went to 5% in October, and that caused a 10% wobble in the stock market. And so the 30-year TIPS real yield is now within like 15 basis points of that high. So you would think, okay, no wonder the market is wobbling. Maybe it's going to wobble 10% instead of 6%. But one difference now versus then is that back then earnings were still falling at about a 3% rate. Now they're rising at a 12% rate. So if you plug that into a discounted cash flow model, and maybe we bring up slide 12, which shows my DCF grid. When you plug in a higher cost of capital in the denominator of a DCF model, obviously it lowers the present value of future cash flows because that's how valuation works. It's the present value of future earnings. But if you do that against a backdrop of falling earnings, it has a bigger impact than when you do it against a backdrop of rising earnings, because that numerator, earnings growth, is sort of the dominant driver of the present value of future returns. So the market should be more resilient today than it was, 5-6 months ago, because now you have that numerator working for you. So I wouldn't be at all surprised if the 10-year goes back to 5%, because so far this rise has been all in real yields, and we haven't even added some term premium to that yet. But the market should be in a better spot to withstand that. Now, if the conversation goes to more rate hikes down the road, that's a different kettle of fish, but we're not there yet.
Let's go into the term premium a little bit, because what is coming down the pike on that front?
Well, so the term premium, let's go to slide 20. So, the term premium, generally speaking, historically, is positive, right? So the term premium is the risk premium that bond investors are supposed to demand when they commit capital to borrowers for long periods of time. So if you're buying a 30-year corporate bond, not that there are many out there, you're going to want to be compensated for some potential credit risk. If you're buying a 30-year government bond, you want to have some protection from inflation, from fiscal foolishness, things like that. And historically, the term premium has correctly been positive, as it should be, because it's a risk premium. But over the past decade or so, it's been more negative than positive, as you can see here in the orange shading. And that's because of central banks' heavy hand, right? Not just the US, but all central banks have been leaning on bond yields through quantitative easing and zero interest rate policy, and in some cases, negative interest rate policy. But that's now gone, with the exception of the Bank of Japan. Central banks have sort of stepped away from the bond market at a time when governments are issuing ever more debt. And so, I don't think it takes a rocket scientist to just conclude that, okay, well, maybe in that kind of environment, there should be a term premium again.
Right.
And right now, and last fall, the term premium did spike from minus 92 basis points to plus 47 basis points when the bond yield went to 5%. But today it's still at -4, even though the bond yield is back, near 4.7 or so. And so if the term premium were also added on top of that, we could easily be back to 5%. And so that's why when I think about bonds, I like them up to, let's say, 10 years, so 10 years or less, especially the belly of the curve. But I don't really want to buy 30-year bonds here because you're not really getting compensated for the likelihood that the U.S. government, and maybe the Canadian government as well, but especially the U.S. government, is going to be running deficits for as far as the eye can see, and investors should get compensated for that. So for me, bonds are a coupon clippers market, if you will, especially intermediate bonds. The bond math is pretty favorable there, right? So if you take the Bloomberg Ag, for instance, or a Treasury index, and you kind of test it for 100 basis point increase in yields, you would lose 2%, 2.5%. If yields were to fall 100 basis points, you would gain 11.5%. So the math is very compelling, but I would stick to kind of the intermediate sector there.
So again, so is the reinvestment risk less of a discussion if we're, again, maybe sitting here for a bit longer?
Reinvestment of what? Of bonds?
For bonds, yeah.
I mean, rising yields has silver linings because you are reinvesting those coupons at higher rates, or if you're buying a 1-year T-bill or a 2-year Treasury note, then you would be reinvesting the proceeds when they mature at higher yields. So, and that's why the bond math actually works pretty well, even when yields are rising, unless they're rising, really, really fast. But you are reinvesting coupons and principal amounts at higher yields when that happens. So it's just a matter of, you're not, at least I'm not buying bonds for capital gains. I think those days are over, but you're getting a decent coupon, you're getting a positive real yield, and you get to reinvest those bonds, presumably, at positive real yields going forward. And so it makes it a viable asset class, but in an era of positive correlation to stocks, it plays a different role than what it used to and what many of us have been used to. So you're not buying it necessarily for diversification. I mean, obviously bonds might have a lower beta than stocks, but they're not going to necessarily save you when the stock market goes down, as we're seeing right now. But it doesn't mean you shouldn't own them. It just means you don't own them for that particular reason.
Right. Gotcha. Okay. Let's go back to stocks. And really the question, let's begin with sort of the equal weight question. As you mentioned, Mag 7 or some of the massive cash generating companies are going to be less influenced ultimately by the rate story. But we've had a big discussion about the equal weighted S&P 500. It's done so well. Does it continue? And there's a question coming in here. Do you think markets have bottomed? I'm going to assume they're talking about equity markets. Or is it a good time actually to get out to take some cash?
Well, I think if we're long-term investors, then you do not want to sell just because the market's down 5%. Yes, it could go down 10% or more, but that enough. If the horizon is long-term, that's not a reason to do it. So, but you bring up a good question, and let's go to slide 4, and that is what inning are we in the cyclical bull market? So we've been talking, in recent months about bullish broadening, and I'm still in that camp. And until the recent wobble, I had mentioned earlier, the S&P is up 28% or was up 28% in like 5 months in a straight line.
Yeah.
And the SPW, which is the equal weighted index, was up 27%. So the market has broadened. And this chart shows every cyclical bull market going back a century or so, and the black line is the current, and you can see it's still kind of a young bull market. If you measure it from the start to the longest bull markets, which is not fair to do, but by that measure, we're only in like the second inning or third inning. If it's against the average bull market, which tends to produce a 90% gain over 30 months, we're maybe in the fourth inning. But if we compare to, let's say, maybe some of the shorter bull markets that occurred during that era of positive stocks to bond correlation, we're probably like in the seventh inning. And that to me is a fair assumption of where we might be. But you mentioned equal weight. Let's go to slide 6. So the equal weighted index, which is the same S&P, but equal weighted, we finally made that all-time high back in March, and now we're back below it. But still, you've got about 71% of stocks above their 200-day moving average. And we've had 6 days in a row of the market going down over the last few weeks. We haven't seen that kind of negative breadth since the pandemic crash. And so the market probably is reasonably oversold here. And I think the fundamentals are still supportive. Yes, the Fed is going to cut less. Maybe some banks don't like that because they're kind of getting squeezed by interest margins anyway. So there are sectors that are still challenged in that way. But there's other sectors that are doing better. The commodity space is looking pretty good here. And that tends to be kind of a smaller cap value type of spaces, but maybe whether it's in the US or in Canada. And so there are parts of the market that I think are still working beyond the Mag 7 and that, I certainly want to be involved in. So I think market breadth should continue to be favorable here. And we just need for this correction to end. But, if we're in the seventh inning, then the next 2 innings are not going to be as robust as the last, 4, right? The kind of the slope of the ascent starts to level off as you get closer and closer to the end. But I don't think we're at the end yet.
Okay, fantastic. It's great to get your views and thoughts and taking a look at these charts and then asking you about them. Just a sort of yes or no, because we just got a second here. Do you think then, based on what you said, it sounds like the answer is no, but do we maybe not need to pay attention to this chatter about an inflection point happening right now? I mean, can we dull that a little bit?
Like as in a stock market top?
Yeah.
I don't think so. I mean, it's always possible. Of course, we're making the best decisions in real time with imperfect information. So we never know what happened until after it's happened. But my sense is that this bull market is intact and that we're having a wobble. And we haven't had a wobble since last October, and the market rallied 28% from that point. So we have to keep that in some perspective.
Exactly. Jurrien Timmer, have a great week. Thank you very much for joining us.